Good evening, everyone, and thank you very much for joining us tonight. I'll just do a quick sound check. If someone can type in yes, if they can hear me. Thank you, Tim. Thank you very much for joining us tonight. This is the final series of what we've been calling our Masterclass. To date, we've gone through and looked at, picking direction. We've looked at trading systems, and we looked at last week trading strategies. And this week we've got Graham O'Brien from the ASX, who's the Senior Manager for Equities Derivatives at the ASX. A very experienced person as far as, people out there in the market, one of the most knowledgeable people around options trading. And he's joined us tonight to cover off a number of different areas that we thought would be of a lot of interest to everyone who's been going through this series. This is in line with the ASX options trading game. Which has been a really good game. We've had a lot of participation. A lot of people have logged in. A lot of people have placed trades. A lot of new people have joined the game. This is, I guess, the final of our structured education. But we'll still be running sessions this week on looking for trades and so forth. There's been a lot going on over the last couple of days, to say the least. Ivan, how are you?
Well, we've been speaking for the last half an hour, so you know how I am.
not that good. Okay.
No, I'm fine. I tell you what, the thing that I love is we've been speaking about this for the last month, probably, and as the market was pushing higher, and the previous time that it broke out as well, we were talking about when you go onto the trading scans on the platform that the banks and the big part of, the 74 or 75 companies that have options over it have not been following the index. So one kind of click and the market just immediately had a lot of air underneath it. Yeah. So I think that was a really interesting indicator that we're talking about. It's been something that was missing from previous rallies, or was missing from this rally. Gosh, the market is going ballistic.
Yeah. And I think we've been, last time we had the last sort of significant pullback, we were talking about the same thing, is that market was going up, but there was dispersion in the market out of the big companies. Some of them had gone up, but even though the market was breaking new highs, none of the top companies were breaking. The bigger companies were breaking.
I tell you what, I know you've got a dispersion product, which you can talk about at the end. But I love. It's like, I think I've spoken to you twice today, and in the hour and a half that we've spoken, I think you mentioned dispersion about 15 times. It's your new buzzword.
No, volatility. That's my new buzzword.
Volatility. Yeah. I can't believe you didn't hold on to your straddle.
Well, I did hold on to it,
just not long enough.
Not long enough.
Yeah. And I can't believe I'm the Muppet who didn't get my freaking strip on. Remember I was talking about it. It was last Thursday. I was like, get one call, 2 puts.
You'd be looking really smart right now. Anyway.
Mate, the decisions I've made in the last 6 months will never, even if I got that right, it would just not polish off anything else. Yeah. Anyway, all good. Graham, hello.
Hello, Evan.
Graham is calling us from the moon, if you're struggling to hear him. Graham, you're in charge of this presentation tonight, by the way, so we're going to stop going on and on. This tonight is really about hearing from Graham. If anyone on session tonight is from Melbourne, by the way, we're running a meetup tomorrow night, and there's about 80 people booked in so far, which is getting close to capacity.
You will hear Graham down there, by the way, definitely.
And Graham is joining us. He's flying down from Melbourne tomorrow to join us.
From Sydney to Melbourne, just to clarify, because...
Yep. And then next week we'll be in Sydney. Anyway, if you want to come along to that session, put into the chat box MEET, meet, and we will get someone to send you an invite to that session. Anyway, Graham, for those of you that haven't come across Graham, he is the Senior Equities Manager for Derivatives at the ASX, and as I mentioned earlier, very, very knowledgeable. We're going to hand the mouse over to Graham, so you should be able to click now on the screen and take control. But at this point, we'll hand over to Graham, and if you've got any questions as Graham goes through, I imagine this is going to take about 25 minutes to 30 minutes to get through what he talks about. Please type them into the chat box as you go, and I might just read out a disclaimer. Any advice contained in tonight's presentation is general only, doesn't take into
Patrick, I think you've gone on to mute at the moment, so we've lost you. Can't hear you at the moment, but happy to take over from here. But everything's of general advice, even when I'm talking from an ASX perspective, even more so. So do you want me to take over now, Patrick? I can see that you're still on mute on your presentation.
Sorry, Ivan muted me.
Yeah, he didn't deserve to continue speaking.
Yeah, okay. Right, you're in charge, Graham. I'll leave it
All
with
right, excellent. Thank you for everyone's time here this afternoon. There, double disclaimer. That's the first I've seen of that, guys. One from Reach Markets, another one from ASX. But our ones is basically the same, saying we can only give general advice in these particular sessions. So before we get started, I always like thinking about when you can actually place orders in the real market as opposed to the game market. And I know in the game it opens up at 20 past 10 in the morning when it comes to single stock options. Our options market opens in line with the equities market. So 10 o'clock in line with those staggered openings, trades through until 4:20, and just ignore that late trading. None of your brokers will want to place orders in late. Trade between that 10 o'clock and 4:20 in single stock. So all the action in the last couple of days has all been in index options with movements in the index, lots of trading in our options contracts between 9:50 and 5 p.m. in that particular market itself. Entering orders in the marketplace. So unlike the game, you do put orders into a live market on the ASX. And importantly, you can enter orders a couple of ways. You can enter them directly into the individual shares themselves. So if we're having a look at this screen at the moment, the top part of the screen is all of the individual series, and the bottom part of the screen itself is the actual tailor-made combinations. So you can enter into an individual call and put in the ASX's market, or you can actually combine those strategies. I know Patrick and I were talking about straddles and strangles before. You can actually enter into a straddle and strangle as a set strategy itself and execute it all in one as opposed to individual legs. And around about 40-odd% of the ASX market is actually transacted via these tailor-made combinations. Majority of people in our market like combining options together. Everything that's traded on the ASX, is at price time priority. So whatever is at the best price that was put in first will be the first dealt in ASX's markets. So in the outright market, that very top part of the screen, we can see BHP here as the example, and we can see that very top market, 191.5, 213.5, with the last sale at 210 in this particular case. So we can see 0.0 on that particular screen. What's that meaning to us at that particular point in time? It's effectively meaning that it actually hasn't had a sale, so that would be a theoretical price at that 210. If I was trading in the options market and I wanted to buy one of these particular options, let's say it's the BHP UM9, you could buy that at 213.5 in the open market at the point in time, where the market's selling us its theoretical value of around 210. Tailor-made combinations, on the other hand, is that part of the bottom part of the screen. It actually combines options and sometimes stock together. So the example that we can see here, BHP 012, is where someone is buying BHP stock and then selling the December 22.45 call in this particular case. So we can see that you could buy the stock at 24.94 and you could sell the option at 238. So you could actually transact that tailor-made combination at this point in time at 22.41. Those trades together, buying one, selling the other, actually reduces your overall cost of buying that stock in that particular transaction. So the characteristics, when we think about these tailor-made combinations, it's all about flexibility, and it allows you to enter multiple legs. And you can have up to 4 legs in our options market. They're traded on the same platform that you trade all the individual shares, the series. Importantly, it ensures all of those legs in the series are executed simultaneously. You don't want to go into a buy right without missing out on the equation, because obviously then you haven't sold that call to reduce the cost of buying that stock. Do that at an overall net price via the tailor-made combination market, which enables you to have a much better chance of transacting in the options market. It does allow for option combinations, and as that example that we saw there, equity to option combinations. Mentioned before, how many legs can we get in there? We can have up to 4 legs. So when I start thinking about iron condors, 4 legs involved in them, butterflies, 3 legs involved in those, we can have up to 4 legs when we're transacting in the market. I think Ivan was talking about doing that strip before, where he was going to do 2 puts to 1 call. You can have up to ratios of 4 to 1 when we're transacting in the marketplace itself. But importantly, they have to all have the same contract size, and most single stock options have a contract size of 100 shares per contract. The good news is that all index options have exactly the same contract size, so you don't have to worry about there. And importantly, even though you might put in 100 contracts to trade, you can get filled in minimum quantities of 1 contract at any particular point in time. The reason why these are such a powerful tool to use with your broker and in the trading system is because of this thing called derived order generation. Not only will the ASX's trading system ensure that you don't get legs, you're getting all of those series transacted at the same time simultaneously, it will also try and ensure that you have the best possible chance to execute your entire order by placing individual series orders that match your whole tailor-made combination. And they can occur in equity, options, or even just in option-to-option combinations. And it's really about trading the market against bids and offers in the prevailing market, placing another order in the marketplace to try and give you the best chance of trading. I think sometimes the easiest way is to give you an example of how it works. So let's assume this client is looking to buy 900 XYZ shares and sell 9 XYZ September $1 calls, and they're happy to pay 7 cents. Now, when we look at the prevailing market, the shares themselves, there's actually 500 shares selling at 108, 400 shares selling at 109, and in the bid part of the marketplace, you can see that 101 is the current bid. If we wanted to execute that particular order at 7 cents, this combination, we're buying at 108, selling at 101, we know we could actually transact 5 contracts immediately at our 7 cent net price. Order in this TMC of 9 at 7. What I expect is 500 shares will be traded at 108, 5 options traded at 101, then we're going to be left with a residual order afterwards. So let's have a look at what might happen in that particular case. We buy those 5 lots. Now we're left with 400 at 109. So previously there was that 400 at 109. The options market's smart enough to place an order on our behalf in that tailor-made combination to sell 4 at 102, knowing that if someone comes and hits our offer in the options market, we can simultaneously buy those 400 shares at 109 to transact our entire 9 lots that we wanted to do in the marketplace. So it automatically derives orders to ensure that we get the best possible chance to transact in the marketplace. Hopefully that gives you a very basic understanding of how those tailor-made combinations work. So if someone came and hit that 4 at 102, the sales that you would see ensuring that you got your 7 cent net price for that whole 9 contracts you traded. The first trade, 500 at 108 that you purchased, selling 5 at 101, 7 cents difference there, that's your 7 cent net price. You would then transact 400 at 109 in the shares and selling 4 at 102 in the options, once again ensuring that 7 cent net price. It really does have some power in ensuring that you have the best possible chance of trading in the market. And you'll see lots of combination orders when you're trading in the game. They're effectively doing these tailor-made combinations to transact into the game platform itself, which then transposes into the physical market to ensure that you're doing combination trading. Importantly though, if you're receiving money when you're trading in the options market, it effectively means you're going to have an obligation to do something in the future. And one of the most powerful things about using the options trading game is ensuring that you have a better understanding of how margining works at the ASX. Because you're at risk if the market moves against you. Let's say you sold some index puts on Friday. Obviously, Monday and today would have been a very painful exercise for someone who sold some index puts. They then have a large risk to the market, that the market's effectively fallen 3.5%. That could have a very negative impact on your written put position in the index. So in that particular case, us at the ASX want to ensure that you have enough money to meet your shortfalls in the marketplace. And that's what margins are all about. So some key themes that we need to be considerate of when we start thinking about margins in the options market. First of all is premium margin. What's the option worth right now? You are going to have to hold that as a margin, as an option seller. It's basically the value of that option, ensuring that if it was needed to be closed out, you have enough money to close out that particular position right now. Initial margin, on the other hand, it actually takes into account what is the future movement of that particular option. We start thinking about risk margins and span requirements when we start thinking about the initial margins. The other three types of margins we see on the screen for yourselves as clients in the market, you don't have to worry about. That's what your broker has to worry about to the clearinghouse. So us as clients need to think of premium margin. Can I cover my losses if I closed out that position right now? And initial margins, which is the potential change in the price of the option. The other key thing at the very bottom, margin multiplier. Every broker in the market will put a margin multiplier over and above ASX's minimum margins that we require in the marketplace. So even though you might use a margin estimator on the ASX's website, please ensure that you know what multiplier your broker will charge over and above the minimums that ASX require. So your premium margin is total derivatives margin. Once again, it's the market value of that particular position at the end of each trading day. So what is that option actually worth? You'll need to hold that as a premium margin. And then there's the initial margin. We use this calculation called standard portfolio analysis of risk. Effectively, it uses 16 different what-if scenarios to determine what would be the worst case on your options position. So if I have a very simple example, if you're short a put, the biggest risk for you is the market falling. So one of those 16 what-if scenarios will be what if the market falls. Another big issue that you need to consider is what if volatility spikes? And I'm sure you've spoken a lot about volatility, Patrick and Ivan, over previous sessions. If volatility was to spike, options will become more expensive. So that would be a worst case scenario for someone selling a put as well. So market falling, volatility going up would be a very poor scenario for someone that sold a put in the marketplace. So let's have a look at how we determine those different scenarios. So scenario one at the very top generally wouldn't be something that we utilize in the market, but that would be, what if the market remained unchanged? What impact would that have on your options positions, volatility going up and time reduced by 2 days? The two key scenarios that we really look at ASX from a day-to-day and the things that will impact the most on you as a client in the market is the underlying equity price going up 3/3 of the range. But what's the range? We actually have volatility ranges and price scan ranges that we publish on the ASX website each and every day to give you an indication of how much we will shock an underlying share price depending on whether it might go up and down. So let's say we have a price scan range on BHP of 10%. If we were doing scenario 11 at ASX, we would increase BHP's share price by 10%, also increase volatility, reduce the time by 2 days. What's that option worth now? The difference between what the option is worth today versus what the option would be worth as a result of those changes is what we would ask for in initial margins. Vice versa, if we were concerned that the market was falling, so people who were short puts in the market, that would be a big impact on them. We will shock BHP's share price down in that case. So what if BHP fell by 10%? Let's revalue that option at that particular point in time. The difference between the value today and that revaluation is what would be required in initial margins. The good thing about the game is it is inbuilt these span scenarios to give you an understanding of what those impacts could be. And as I said before, that price scan range on XJO, for instance, we're looking at around about a 262-point movement. So it sounds like a lot, but when you think about a 2-day price movement in XJO, we've pretty much had a 262-point range over the last couple of days. So it does sound a lot. It's definitely something that you need to be cognizant of. And AGL is the other example. That one was 5%, so we would shock AGL by 5%. I do have a star against both of those price shocks at the moment. We change those price scan ranges at ASX on a regular basis. Please make sure that you check the ASX website to see what the current price scan ranges are. The other thing we shock is volatility. And obviously, in falling markets, volatility can spike, and it has done over the last couple of days. XJO, for instance, has a price scan range or a volatility scan range of 40%. So we'll actually increase volatility by that 40%. So if volatility was 20% earlier in the week, and we shock it by 40%, and then you're looking at effectively an 8% movement in the volatility as a result. Importantly, though, for those of you that have positions across multiple stocks, you do get some concessions out of spam margining at ASX. So at the very top here, we can see BHP and Rio. We know that often BHP's share price moves up as Rio's share price goes up, and as Rio's share price falls, BHP's share price falls. ASX actually provides a 40% offset between positions in BHP or Rio. The only thing you need to be conscious of is that you need to be effectively long BHP via your options positions and short Rio via your options positions to be able to benefit from that offset. You can't be both long because obviously the market will move in line with each other. And then finally, we do have short option minimum parameters. Effectively, we'll never price an option below 1 cent and below 1 index point in that particular case when it comes to index. So even though an option might be trading at lower on the screen, we will only ever price it down to 1 cent via the options market itself. So hopefully that's given you some basic understanding into the basis behind how we margin at ASX. I think some of the best ways to understand how that margin is impacted is definitely by using the game and being able to see some of those impacts on margins. I'm sure many of you that may have been short options via the game will definitely have seen some of those impacts on margins over the last couple of days with your portfolios. So we've gone through what are the trading hours, we've gone through tailor-made combinations, and we've also gone through margins. When I'm starting to think about strategies that are more advanced in the marketplace, we like to call them what we'd say a level 2 options trading strategies. Importantly, if you're getting advice from someone, they will need to have passed an exam that is accredited by the Australian Securities Investment Commission, ASIC. It shows that they know what they're talking about when it comes to the more complex options trading strategies and the options trading strategies that require margins. So anyone who's writing options or taking or writing LIPOs, they will need level 2 accreditation before they can actually give you advice in this space. So let's have a quick look at some combinations. There are always things where you have more than one option position. And as I said before, they're often done by tailor-made combinations. So 40% of the market is currently via these tailor-made combinations themselves. There's a whole range of different combination strategies available to people at the market that they're using day to day. For moderate bullish movements in the market, people use bull spreads. If it's calls that make up that bull spread, then you'll find that they paid money so they don't have a risk to the marketplace on that trade or an obligation. Whereas if they use puts to construct the bull spread, you'll find that they actually have a credit, they'll receive a premium, and they'll actually have to pay margins on those trades. And so moderate calls in the market, people can construct them using puts. That is when they'll actually be paying money, and from that particular case, they'll actually have no obligation, where the call side of the equation is where they have an obligation to the marketplace. I always think of, what do you want the market to do as a bull? You want it to go up. You buy calls if you want the market to go up, so that's the debit side of the equation. You buy puts when you think the market's going to go down, so that's the debit side of the equation there as well. There's also volatility strategies. So you've got straddles and strangles, where you can buy those straddles and strangles and hoping for a big movement in the marketplace. and we've had a lot of those recently. So people who purchased straddles or strangles last week might be looking very profitable this week. Whereas if you don't think the market's going to move at all, you would sell a straddle or strangle, hope the market remains steady, receive a credit, but have a lot of risk when the market falls, as it has over the last couple of days. So let's have a quick look at bull and bear spreads first. So they may offer better profit potentials than outright purchase or sale of options. Effectively, if you buy a call option, you're buying the unlimited upside of that particular stock. Where when you buy a bull spread, you're buying the range and where you think the stock will move to at a much reduced price than you would have if you actually purchased the outright call. Gives you a better profit potential in that particular case. So if I have a think about that, bull call spread, it can help reduce the cost of the outright purchase of the call. Bull put spread will actually help reduce the risk of selling puts in the market. When I think about cash flows when we're moving in the market, you're paying money up front. You pay that net premium when we're buying the bull spread. You don't have margins. Maximum profit loss is the difference between the two strikes. So if I buy a $20 strike, I sell a $21 strike, the most I can make is the dollar between the two, less my costs. Unwanted exercise is less likely. However, on the put side of the equation, we're receiving a premium. We're going to have to pay margins, and our maximum profit or loss still will be between those two strikes, but our maximum profit is what we receive. Our maximum risk is the difference between the two strikes, less what we received from the trade itself. I think this helps us in understanding why they can be more profitable. When we think about a buy bought call over the life of the option, the stock can go up or down, only when that stock is above that strike price at expiry is when you're going to make money on that bought call. However, if we do a bull spread, for instance, we might be able to have an upper and a lower strike where we can actually make money in between the two trades. So yes, we are capping our profits. We're limiting our losses because we're reducing the cost, but we're making profits in between those regions as opposed to relying on a big movement up or down in the market. And that's the real reason why people enter into bull spreads themselves. Bear spreads, on the other hand, just flip it around. We want the market to go down. So if we do a bear put spread, that's when you're going to pay. It's going to help reduce the cost of puts. And I imagine the cost of puts will have increased significantly. In some cases, the cost of a put will have doubled just in the last couple of days because of the doubling in volatility that we've been experiencing. So to help reduce the cost of that put, if you don't think the market's going to continue to fall, is by selling another put below where the market might be trading to actually help reduce some of that cost. So similarly, as we saw before with the bull spreads, cash flows. When we do the bear put, we're paying money, we pay that net premium, you don't have margins, it's just the difference between the strikes is our maximum profit. Use calls to construct the trading strategy, you're going to receive a net premium, but you are going to have to pay margins in that particular case. So with a bought put, the only time we make money is when the actual stock falls below that strike price at expiry, if we were thinking at expiry. By limiting or putting that lower strike in with our particular trade, we might actually be able to profit as the market remains within those ranges, and at a much lower cost still profit from movements in the marketplace. So generally, people who are doing debit bull and bear spreads, they're trying to reduce the cost of entry. People who are doing credit bull and bear spreads, they're the ones that are actually trying to reduce their risk of having a naked option position in the marketplace. So buyers limit profit, sellers limit risk when it comes to those particular spreads. We've got the whole range of equations that can occur there. So your bull call spread, obviously pay debit. Bull put spread, we receive a credit. Bear call, we receive a credit. Bear put, we pay a debit. And margins are when we've received some money from those particular equations. Conscious of time, short straddles and strangles. This is the trade that was probably very, very popular when we had low volatility environment. The market continued to rally. Everyone was confident in the market to move forward. Short straddles and strangles are actually quite popular. However, I'm sure they're very unpopular in the last couple of days in the options market. So when we're thinking about short straddles or strangles, we actually expect the market to be neutral. The difference between a straddle or strangle is generally the straddle will sell at the money call and put options. So if we have a $20 stock, someone will sell a $20 call and a $20 put. trying to take in all that premium from the options market. Strangles, on the other hand, allow you a little bit of movement before you actually get some risk into the trade. You don't make as much, but you sell out of the money calls and puts, so you're earning less, but the movement has to happen more before you actually make a loss in the marketplace itself. Sorry, I'm just trying to click on the next slide. Here we go. So if I think about a short, straddle, and strangle, where are we going to make money? Anything in between these two lines. If we had obviously a strangle in this case where we had an upper and lower strike, we're going to be making money in those particular in that particular region. Where we're at risk is when the market falls significantly, where it's below the put strike. Investor losses are only limited to if the share price fell. The market rallied significantly. There's potentially unlimited losses because there's no limit to how high a share price can go. So people that may have been shorting straddles and strangles will be very concerned about these big falls that have been experiencing the market, because it means that they're actually losing more than what they would have received in premium, I would suspect, in the marketplace. So you receive the premium, unfortunately, unlimited risk on the upside with a very limited reward. But be very careful of these downside risks of the strike, less the movement itself. Now, I went very quickly there, guys, to go through some of those trading strategies, but and I think might pass back to you, but I think probably the trade that has been more advantageous at the moment is the long straddle or strangle rather than the short one that has been more popular over the last week or so.
Thank you, Graham. We've got this slide up from our last presentation, but the previous session we went through these examples in quite a bit of detail. So what we might do is skip out of here, escape, and have a look at the market, have a bit of a chat about that. I guess one of the great things about options trading is you've got the opportunity to trade based on a directional view and based on volatility as well. And for us recently, with the market as recent as the last couple of days, we'd set our trades up at these levels where my mouse is right now, based on a view that we thought it might go up, but we weren't really sure. We thought what we were confident about is that a move would happen. And so we went long volatility, which was the long straddle strategy that we'd spoken about in the last presentation. And I think I'd mentioned was the one that I'd personally entered into. And so what we're looking for is not a move up or down, but a move that was significant in one way or the other, and preferably an increase in volatility. And so after positioning ourselves into the trade back on the day that I've got my mouse over, the market kind of went up, it consolidated a little bit. Volatility actually came off from when we entered into the trade, or when I entered into the trade originally, and then the market came off significantly. And what we saw was volatility increase yesterday by about 30 or 40%, and the share price move as well. And both those things were great for that trade, and we had a lot of people in long straddles because it's basically all I'd spoken about for 3 weeks. And so there was some good trades.
Aside from me.
Yeah. Aside from you, yeah. Well, Ivan was thinking about getting into it and then got busy and didn't get around to it, but that's life. Having said that, though, if I had to have got busy and was ignoring the market, I could have got out today. And so people that were in on that sort of trade would usually move into the trade. They can take decent sized capital in because they're trading against the clock. So the at-risk amount that I took into the trade was about $6,000, whereas usually on a directional trade I might take $4,000 or something like that. This is my usual play money trading, but with a straddle I can take a little bit more.
Can I just quickly price it up? I'm actually just because I remember the strikes you had, and I'm just going to go into the cookbook.
While you're doing that, I think it's Mark, M-A-R-K, without the A, ask the question, which bank are you trading through? So using our platform, yes, March, using our platform, you can trade directly through us. So effectively, the word terminology you're using who do we use for brokerage? We offer the ability to be able to trade, so effectively offer brokerage type services we don't use the term for ourselves as brokers. We're, I guess, an online broker, but we don't offer the traditional over-the-phone stuff. But you can trade any of the strategies we do through our platform. So the long straddle was a trade that I got in.
176.
Yep.
Yeah, and that's 70.25 March, wasn't it? Yeah.
70.25. Yeah.
Yeah.
Yep.
Wow. When'd you get out?
I don't like to talk about too early. Too early.
Yeah, wow.
But yeah, in the twos. So yeah, it was a good trade, but it was a very good trade if you held on. And look, that's what we.
This is the interesting thing about your trading versus my trading is I'd actually be holding on today, and I'm still waiting till tomorrow. And typically, I'd be that guy who'd be holding on.
Yep.
Well, actually, the trade that I was talking about on Thursday was to put on one call, two puts, and close down one put around about a 200-point move.
Yep.
And then you're in a traditional straddle, and I would have held that for sort of about midway through life. But that's backfired for me quite a lot as well. It comes from sort of the trading during GFC and holding on for longer. And it'd be interesting to see, actually, I think we could run a, once we get these, actually we're going to confirm the university guys coming in.
Yep.
We can probably now disclose who it is, which is University of Sydney. We actually got to confirm those guys, and that would be a really good project for them to see over time, because they can go back further in time and see if, what holding versus not holding means as part of a long-term strategy. Because I think that it feels to me like you get out too early, but you've had, you've timed it to perfection 2 out of 3 times, or 3 out of 4 times.
Yeah, I think, Ivan, one of the things you have to be careful of, though, is that idea that volatility is mean reverting. So if you hold on too long, then eventually volatility is going to come back.
Well, it's interesting. And the weird thing about this trade is if you look here at the moment, what's vol? 14.71. So volatility was actually on those strikes was higher yesterday.
Yep. Yeah, it's quite amazing. But we did have an afternoon where the market come back a little bit. So I think on the market open, it might have been a little bit higher.
Yeah. Hey, Brendan just clarified a question there, and thank you for doing that. I think Brendan said, I think he wants to know which bank your money sits with when you're not trading. Thank you for asking that question. It sits with Macquarie Bank when you're trading with us.
And that account is actually in your own name. You've got full control over it. And the money coming in and out is controlled by our clearer, which is Pershing. Pershing is a company that is a fully owned subsidiary of Bank of New York Mellon, one of the biggest clearers in the world. And the only time they take money out is to actually ultimately put it into ACH to cover margin obligations plus their designated buffer.
And the other point is, how do you put money in and how do you take money out, etc. So I have Macquarie. I use Macquarie Bank for a number of different things. So I can transfer between accounts. I can transfer money in or out as I wish. So you just do it online. But there's no restriction to how you handle that. Yep.
Yep. Yes, indeed.
All right. Okay. Paul. G'day, Paul. The call ratio back spread I suggested in that same webinar would be in safe territory 2.
Yes, it would be.
It would be indeed. Yeah. But I guess I
don't remember the strikes though.
Neither, but I think if you want to do, one of the great things about this platform and our technology is that if you want to look at an options trade, there's a couple of things that you can do that make it really easy for you to be able to set up a trade. The first thing is, if you want to, what Paul suggested is, I imagine what we would have ranked as quite a sophisticated trade. So if we put ratio in and we say call ratio back spread.
In this case, it was a put.
Okay.
Yeah, I think we were talking about a put spread.
I think so, based on the payoff. Yep.
Yeah.
Click. And then you choose the period. Anyway, Ivan's got trigger happy and just set the trade up. But,
never happened with me before, ever.
But anyway, basically there's a couple of things you want to look at here. One is the strategy is now set up for you. So you can see the legs of the trade. It doesn't matter what you do. You do an iron condor, you do whatever you want to do. And then you can go up to the payoff diagram, have a look at the payoff diagram. And in this instance, we've chosen March. I think we went a bit further out in time. What am I doing here? Sorry, apologies. Clicking the wrong button. So we'll go out to April. And if in this instance you wanted to have a look at this trade, you could go payoff diagram, or you could go matrix and have a look at, okay, what's going to happen. Now, I'm not sure if I have got priced this up properly for you, Paul, but in this instance here, your max loss was $1,900 and your maximum profit was $65,000, and what you wanted was the price to come off. So if you'd started up here, I imagine you could do something similar. Volatility adjustment, excuse me. If volatility went up by 20%, you could see the improvement in this instance when Paul had set the trade up, it had gone up by 50%. So you can see from the initial max loss, if you had done the trade Paul had done when he'd done it, which the market was up probably up around here, you can see that a significant profit would be made.
Strikes would have been different, though.
Yeah, strikes would have been different. Everything would have been different. But anyway, it's very easy to price things up and play around with it. And as you did say, Paul, in the money strikes, you were sold in the money and bought out the money. Yeah.
Yeah, I think we were looking at a couple of different options, but anyway, I think, yeah, my strap would have done pretty well.
It would have done exceptionally well. Do you want to price it up?
Sure. So the two strategies we were talking about on Thursday, which was slight modifications of the straddle, which is a strip and a strap. So a strap involves buying two calls, one put, which has a little bit of a call, which is a bullish bias, and a strip, which is a call and two puts, which has got a bearish bias. So we were looking at that. Again, same kind of expiry. Except we were looking at that point in time as 70. I don't remember what the price was though, which doesn't really help so much. But again, it was 70.25 that we're looking in the Marches, and it was a hell of a lot cheaper than that. But anyway, interesting kind of modification. What would you do now? So we've got look, Ivy ranks high.
Yeah.
Not high enough for what?
I don't know. I think I had this conversation this afternoon, and again, I think you want to you really want to you're trading a view right now. So my view is not enough information for me to have one. So do you catch a falling knife, or do you volatility is not quite high enough for me to want to play a volatility strategy on the downside, or So I think, and we're in too wide a range. So for me, it's a wait. I want to see what happens overnight. If the market rebounded, I'd be waiting for the opportunity, if volatility stays up, to maybe go into bear call, something like that, out of the money above. Maybe try and start setting into play an iron condor. But I'd really want to wait to get some sort of a view on whether or not the world actually thinks this is going to escalate. And I don't know at this point in time. I think probably I wouldn't want to set that below the bear put side of it, iron condor, and the bull put side of it, iron condor in at this point in time. But maybe some bear calls if we see a bit of a recovery and vol is up. I'd be happy to be above where we were recently trading, or up at those levels.
You're such a reasonable man. I'd honestly, I think that if you're going to do anything specifically on the XJ, by the way, and we probably should look at some others, but I think the Ivy rank above 50 at 85, massive spike, has ways to go. So probably would not go in full pelt into this, but I would do a small iron condor trade around here. Just on the basis that I think that vol's probably going to come back here into the 12% range. on the back of that, you've got a 20 to 50% fall. Even if that takes a little bit of time to go on and happen, benefit. The other thing that I'd probably look at is just outside of that.
Can you go back to that? Because
Sure.
Just to talk through this. So what have you set up?
Iron Condor.
Yep.
It's a 2 grand Iron Condor, so just 3 lots.
Yep.
You'd probably be just a little bit higher than that.
Expiry though, 19th.
Yeah, I mean, you'd hit it.
Wow.
You'd hit it as quickly as possible. You might even try to do a weekly in here, just to really get the most out of that. But it's probably just the risk reward is starting to get a little bit not quite there. But I think 19th of March, super short term. Now you got me confused. Where's the next expiry? Yeah, 19th of March. Sorry, just double checking that's a major. So 3800 1196. That's not a bad payoff for an Iron Condor. And it's a vol play ultimately, right? So I think that's massive. The other thing you can look at here is going to the stock screener and actually finding low IV rank. So, I mean, Maya doesn't matter because they don't have options anymore. But, these kind of trades, Worley with low IV rank, Coltex with low IV rank, although Coltex is going through a buyout at the moment, takeover, but QBE, AGL, these are stocks that haven't followed the very strong spike in volatility across the market. So there's probably bigger plays here. Have a look at Worley. There's actually quite an interesting play there. Volatility's really come off. It's sort of higher around about that 36.5 range. Currently 29. Massive drop off in volatility despite everything else. Interesting play there. Although probably somewhere in the middle of where that range is. AGL again, sort of that's sort of moving up. Again in the middle of the range, so sort of vol neutral kind of strategies. What else is there out of some stocks that we follow? Fortescue's been interesting actually. Again, have a look at that. That's some very nice price action coming right back in. Vol spiking back up. Interesting again, I think. So there's sort of a couple of these standouts. And then if you go down to the extreme other end, I mean, look at Transurban. That's some seriously spiking volatility. Although relatively, WiseTech as an IT company, that's been, BetaShares announced a new tech index. WiseTech is a major component along with Afterpay. Have a look at that drop off. That's seriously soul destroying. Around about $30 to $20 in a day.
Yeah, they did 27% a day last Wednesday, I think it was. Yeah.
That's the 19th, yeah.
Yep.
That's again, that's an Iron Condor type play right there.
Isn't it?
For everything we've got. The only interesting thing there is that IV versus HV that's worth looking at. So although, it's not a lot of information that we've got on implied volatility, but on the back of that, you're looking there at 50 IV. HV says that, there's ways to go there. I see that's sort of what you expect. High IV rank typically has high IV over HV, and so that just means that there's expensive implied volatility over what historically has happened over a rolling 30-day period. Again, actually a candidate for an Iron Condor. Look at that. That's the sort of price action. It's come off. It's probably going to sit there and consolidate for a bit. Volatility is high, massive bonus. 14 to 23. Typically a stock that doesn't move around a lot. That could be an interesting play. What about trading rules? Was there anything that lined up at their close? I don't think that. Oh, there we go. It's a couple of lit shorts. So this is interesting. How markets breaking out 52-week highs. You expect 2
days
Christmas
later.
2 days later, there's five lit shorts.
And we've not had 5 lit longs at any point in time.
Yeah.
It's just a weird market, and that's been.
This is my mic drop moment. I'm just gonna storm out.
That's been the main thing we've been talking about, and one of the reasons why we've been looking for vol, not direction.
Yeah.
Through this period, because there's just something that hasn't made a lot of sense, as we've gone up. Not to say it's got anything to do with coronavirus or anything like that, but yeah, it's there's some sort of
the world is conspiring against us.
Yeah, correct. If anyone's got any question, please type them in. I think I noticed we've taken quite a bit of your time up. We're going to be running a session tomorrow at midday on how do you put a hedge into your portfolio. Everyone's long at the moment, and
we are.
We are. Well, I am anyway. Well, it just today it just occurred to me that it would be a timely thing to do, and I sent an invite out on this topic. There is, a million different ways you can go along the market, but there are very few ways you can actually go short or set something into your portfolio that if there is a lot of volatility or there is a structural change in our attitude of investors, that you'll see different types of companies perform different ways. So you'll see what we've got a fairly high correlation, although we've seen the correlation of our market not be there in the way that it has been at least in the top stocks. How do you actually make money out of those situations? How do you put things into your portfolio where you can profit from those types of situations? So we're going to talk about that at midday tomorrow. If anyone wants to come along, just type yes into your chat box, and I'll get someone to invite you along to that session. So
so that's actually, it is a super interesting product because I remember we were talking about this in this very room, must have been 3 months ago. It was the previous dispersion product, and the market vol was actually dropping off, and it still did really well. So
incredibly well.
Yeah. So interesting sort of, and actually part of that gives you international exposure, which of course we need so much more of in our portfolios in Australia. And a lot of that was driven by the Tesla capitulation and price, where it just it just completely fell off earth. And of course the last couple of weeks it's just been flying up until probably
the idea
couple of days,
is that if you're looking for a hedge, trying to pick the time the market comes off is difficult. But at the moment, volatility is at very low levels, and we don't have that short of memories that we go back to a period where volatility levels would have been comfortably sitting up at, say, 16 to 18% and trading up to...
That'd be a quiet vol day.
That would be very, very quiet. But then also trading up to 30% to 50%, really, if something major happens. And 11-year bull market, not saying it's over yet, but at some point in time we expect it to be. And it's good to have something sitting in your portfolio that you can make money, serious money, when those volatility levels increase and when the dispersion between the stocks sitting in that basket increase as well. So if you want to come along to that session, type yes. We'll get you an invite across. Other than that, what have we got? A question here from Brendan.
Are you better off buying less of more expensive options rather than more of cheaper options so the fees are not so high? So, Brendan, I think the best answer to that question is options. Like with options, you definitely get what you pay for. So I think it's not so much the fees that you should be concerned about. It's actually more the delta, and you can use the delta as a way of gauging. It's not completely the correct way of doing it, but it gives you an indication of the probability of profit. So if you've got a delta of, say, 70 on an option, you know that there's sort of a 70% chance that it's going to expire in the money. That's sort of the rough calculation, or at least you can use it for those methods. So I'd probably say that's what you should be looking at. As a beginning trader, you're probably better off buying in the money options versus out of the money options, and the reason for that is just the lower leverage. I mean, obviously, you'll have your view for whatever you're doing, and one of the ways to go on and get really good at finding the right strikes is to go into the back tester. And so, you can go historically look at, if we go, for example, just going to bring up whatever's here, but let's say CIMIC Group. It's Yeah. Let's say Simi Group, for example, right? It's 31.23, and you might have, you might form a bullish view on this. And so the couple of different things you can try is in the backtest to create a, $35 dollar call, $37.50, or a $30 call, and see how they performed if the market went back to 40. So there's probably, a whole heap of different options that you can try, and just see how they react differently. There is also in the education portal, there's a video, and it talks about under the strategies guide, you can go on and find a long call and long put. And there's actually a little bit of analysis around which particular options and how they performed over time. And then also the other thing is that probably worthwhile checking the spreads, because in our experience, what has happened is, I'm not going to try to watch that, but in our experience, what has happened is if you ended up getting into a long put versus a put spread in any of the past games when the market's been falling off or vice versa, you'd actually still be better off getting into a spread, because you get extra kind of covered precise leverage in. So anyway, slightly different way of thinking about options, because a typical market will be the complete two ends of the spectrum. And I don't know if Graham is still on, I'm sure he can confirm this, that either we have sort of bought calls and puts, or we have people trading sort of short straddles. So anyway, interesting sort of observation of the market, I think. So a recording of this will be available, I take it?
What we'll do is
you whispered that. It was actually quite creepy, Patrick.
We'll put it on the, if you're getting our morning report, we'll put it in the morning report. Probably not tomorrow. Best endeavours tomorrow, otherwise the day after. And we've got a YouTube channel now.
Oh,
yep. And we haven't kind of promoted it yet, but it'll be on the YouTube channel tomorrow at some point in time. Email us, email Tim or admin or whatever, and we'll get you a link to it.
You're so fintech now.
Yeah, really stepping my game up. A couple of just sort of housekeeping. So anyone that wants to come onto the session, I said say yes. If you haven't already got a trial to our platform, type in trial, and we'll give you a month trial. And so you can use our platform, all our tools, get access to our trade ideas. We've done a lot of work on education. Ivan's on a bit of it now, but sort of any of the questions you've asked tonight are covered in a lot more detail in the videos that we've shot over a fair period of time, and we'll keep contributing to that. But if you would like to get access to that, just type in trial and we'll give you a trial for 30 days. If you want to come to the webcast tomorrow, type in yes. If you would like to come to the meetup, just probably the easiest way is just to go onto one of our morning reports and just book in via that, or you would have been sent an invite. Today we sent a summary of the trading game to everyone, the leaderboard. You could have booked in via that as well. So there's plenty of stuff that we send you if you want to engage in the things we're doing. You can.
I'm seeing a lot of you this week.
Yeah, way too much. So anyway, I think for those of you that have requested trials or to come along to the webcast tomorrow, we'll sort that out for you first thing in the morning. And for everyone else, thank you very much for coming to the session tonight. For those, I can see a couple of names there that I know are booked in to see us tomorrow or next week in Sydney. Look forward to seeing you in person there. And to everyone else, thank you and good night. Graham, thank you for coming onto the session tonight. Much appreciated. We really appreciate the support of the ASX. Ivan, last week.
I'll see you boys
Thanks,
tomorrow night.
Brendan, for your kind words too.
Yep. Thanks, Graham. Cheers.
Cheers. Bye.